Hello, welcome to today's live stream challenge. Just a quick recap of what we found last time. Last time I think we added, I believe two A tier stocks. Keep in mind they are probably like A minus. I'm just gonna go over them. So one was 1914, which is Japan Foundation Engineering. They have a 3% dividend yield. Management has been consistently buying back shares rather aggressively. But the downside is that it's a low margin business. It seems stable. They have some outperformance in U.S. operations. Sorry, potential outperformance. So they have U.S. operations right now, and it was kind of unclear to me from their investor presentation whether they would be able to continue to generate more revenues in the U.S. or if that was a one-off thing. So yeah, but it's trading at really low enterprise value multiples because of how much cash they have, and because they're trading at a low. Bring back up. Do I have 1914 in my other? Did I end up doing one? Yes, I did. So 1914, yeah. So because there's so much cash, or in long-term investments, I should say, they're trading at 3.2 times EV/EBIT multiples, 12 times PE, and they're trading at half times book. So kind of cheap, but then I like to have some element of growth, or else it could definitely be a value trap. So that's why it's A minus. And then there was 1941. Trudenko. So this one has 3.5% dividend yield. They have a lot of long-term investments. So they essentially have a market cap of like 200 billion, and they have like over 100 billion of long-term assets. So after you subtract net cash on top of that, they have enterprise value of only like 25% of their total market cap. So the problem with them is that they I don't really see a clear path to like growth for the company. They say they're going to spend quite a bit of money on growth initiatives to generate more profits, but I just don't know. I don't see how that's going to happen. But they said they're going to take 35 billion out of their 100 or so long-term investments and use it to, pay more dividends and also perform more buybacks. So that is definitely a positive for the company. It's really the growth aspect. How's it going to grow revenues and improve its margins? Those are the two major things for those companies. And because it was rather unclear from their investment presentation, like I like to be able to figure something out like fast. Like if the path to growth was clear, then management should communicate it easily. If it's not that easy to communicate, then typically if you read something and you find that it's not that easy, then it means that it could indicate that it's not the path to the promised land is not that easy. So yeah, so we'll start from scratch today, and let me load up the Japanese company handbook. Oops, forgot to do that. Do that real quick. And last time we used Koyfin, so I have this new process that I've created to make my life a lot easier and faster, which is instead of going through each name one by one, page by page, what I do is I load up 20 stocks into unclassified, and then I looked at based off like certain metrics that are common, I look at the company and determine, hey, what are the top, 2 or 3 compelling companies in this list, and look at them. And if there's none, there's none. But essentially, it's what are those companies on that list that are hard pass, and which companies do I look further. So last time we kind of went through that list. We deleted some that are clearly a no-go, and then we kind of isolated it to a few companies out of that list of 20. And then we found these companies that we're going to go through. So before going to the Japanese company handbook, see, last time we were at, okay, I believe we're way past 163. I believe we are way past this one. We are at, let's see, we covered up to 1946, 1952, 1961. Okay, so let's scroll down and pretend that 1961. Yeah. So something here. So we're at 1979 now. So that's cool. 1979. So page 178 on the PDF. Yeah. So 179. So yeah, we'll start here. So last time we found Chudenko, which as you can see here, yeah. So just an overview. It had like 102. I think in the most recent financial statements, they have even more long-term investments. So the enterprise value is actually a bit lower than that. But you can see from the EBIT perspective, it's because of they have so much long-term investments. The enterprise value to EBIT is extraordinarily low. But we've already went through that one. Actually, this is not a no-go. We should further research needed. Yeah, so this one isn't entirely clear. You need to spend more time on it, but yeah. Okay, next company, Nippon Raytech. Let's see here. What do we have here? So, MCAP of 50, enterprise value of 43, 16 of long-term investments. So you get 26 enterprise value, including long-term investments. Div yield about 4%. See, so it has had poor CAGR over the last 5 years, so it probably doesn't move much. EBIT margins are mid-single digits. P 10 times, EBIT 8 times. Free cash flow. Okay. I don't like that it compounded like so poorly last couple of years, but let's take a look at it. It's worth taking a look. Okay, so price has gone up recently, last 5 years. Oh, I see. So it's one of these situations. So it tanked a lot, and now it's resurfaced. So okay. I see 2020 went up a lot. 900. Wow, dropped basically down to like 20% of that. So it dropped 80% before finally rebounding back. I see. Okay, so that's why the performance over the last 5 years has been rather poor, I guess. Let's see, what do they do? Nippon Raytech. Nippon Raytech engages in the railway electrical equipment construction business in Japan. The company's railway electrical equipment includes signal equipment, train track equipment, power generation, and transformation equipment, electric light power equipment, and information communication system constructions, as well as transmission line equipment. Also engages, constructs signage and landscape sign, traffic signs, signals, and road information control systems. In addition, the company offers outdoor, indoor electric installation work. Solar power. Okay, so this is just other things. Okay, let's take a look at their profitability. Remember, it was like mid-single-digit EBIT margins. So let's see here. Let's see on an annual basis, they are okay. EBIT margins have dropped. They were formerly into, I guess, in the mid to high single digits, 7 to 8%. Let's see here. SG&A margin went up, so okay, that's not good. So the costs have gone up over time. How's the income statement looking? So not much growth in revenues. So you can see barely any growth in revenues, up 20% over the last 9-10 years. So that's not great. Profitability fluctuating, gotten worse. What's last 12 months? Because their price has resurrected a little bit. Okay, so their revenues have grown. Okay, some operating leverage here. So getting more profitable. Is this historically the most profitable they've been? One of them. Okay, so I have to figure out what it is that has led to this recent growth. Okay, so they actually have debt. Had some growth multiples. So this company probably had a lot of long-term investments. Let's see here. Long-term investments, 17. Right, they do have a lot of long-term investments. ROIC, very low. Okay, well, let's take a look. Let's see if there's anything that's like growing with the company. All these construction companies have been doing, like the industry as a whole has been doing slightly better recently. Okay, corporate overview. What is their business? Railroad Electric Facility Division. This division is a pioneer in railroad electric facility construction, which has been involved in railroad electrification work and Shinkansen construction nationwide from Hokkaido in the north to Kyushu in the south. In addition to power generation and transformation facilities for supplying electricity to trains, train lines, facilities, and transmission lines. Okay. Okay, so I guess Road Facility Division. This division sells safety facility products nationwide, centering on traffic safety. Okay. Indoor, outdoor electric facility division. The company deploys design, management, and construction of electric facilities on a nationwide scale as a group with excellent technology and skills, with the first priority of ensuring safety. Power transmission line division. Okay, so a lot of this would be, so it would be very beneficial if they were like building more like railroads, electric railroad facilities. So if they're building more of that, that would be good for the company. Okay, let's see IR information. Okay. Nice. They do have. Nice. Okay. So the key thing here is growth, because if I don't see the growth, or if we believe that, so essentially, okay, when I put a timer for 50 minutes, essentially if we think that revenue is going to be stagnating, there's not much point. The only way we can see that this stock going up, essentially, if their costs keep going down, or if they have some type of contract, or they're able to charge more, and we see that revenues are going to continue to grow. So yeah. Orders received declined to 62.7 billion. What is the revenue? 57, right? The revenue is 57. So we had to look at the percentage of which they fulfill their orders. Orders, especially those from major customers, were on a recovery track and surpassed the previous fiscal year's levels in the railroad electric facility, road facility, in indoor-outdoor. Okay. The power transmission line facility saw a reactionary fall in orders after receiving orders for multiple large projects in the previous fiscal year. Okay, so they had several large projects. So the question is, are they going to continue having these projects for development of power transmission line networks in Japan? The sales increased by 10.1 billion year over year to 68.6 billion. Oh, so that's really good. So yeah, that's pretty high. Okay, net sales were on a record high thanks to progress and completion of construction in each division on the back of robust orders received in the fiscal year under review, in addition to abundant construction contracts carried over from oops, I just lost my where I was in this thing. From the previous fiscal year. In particular, the power transmission line facility division drove the increase in net sales with the progress in construction works for large projects. So power transmission line facility division, and then they have a lot of more projects. So this sounds like one-off, so that's not good. Operating profits increased. So let's see here. So last year it was around, this looks like 58. So 58, you add 10, it's like a 7-8% increase in revenues. And then this was a, let's see, 1.7 billion operating profit, 5.1, so that's 3.4. Operating profit improved by 50%. Improved by 50%. So that's the operating margin here. Cost reduction measures, so that's good, including price negotiations with customers, so they have some level of pricing power, maybe. Efficient personal allocation, that's good. Cuts in expenses, good. Okay, so another thing that I noted earlier was a cost margin, like cost margins going down, or SG&A going down would be good for this company. So we have less orders, higher net sales, but this is fulfilling probably some backlog from the previous year. Probably what happened. Okay. Electric facility work. So this is the highest one. Real estate leasing business, still very small. Okay. Let's skip through this. Orders from major customers were on a recovery track, secured orders from East Japan Railway Company for capital investment in safe and stable transportation and facility reinforcement. What's East Japan Railway Company? Let's take a look at that. Is that public or is that government? Oh, JR. JR is a stock. I know that, I think. Let's see. Yeah, 9020. So, okay, so the way to actually value this company then would be to look at what are JR East's potential projects in the future, because if they're going to keep expanding, then this company is going to benefit from that. Okay. Net sales increased by 3.2 billion on year to 35.6. Progress in completion of construction works, including utility pole replacement, for Shinkansen bullet trains, and interlocking device replacement at Oku Station, contribute to the increase. Also strive to negotiate prices actively with clients, so they have some pricing power. Higher net sales, higher orders received, so increasing pricing, so that's good. Okay, let's see. Next is electric facility work, road. Oh, so this is all electric facility work, but you have different ones. So railroad electric facility, road facility. Orders didn't really change much, but stayed, yeah. Orders from prefectural police for traffic signal works remained robust. Also secured orders for structure improvement works on freeways, tunnel lighting works, and other projects. Net sales increased year on year due to traffic signal. Okay, let's see if we can. We have no one watching right now, so I can expedite this by just reading myself, and then when someone pops in, I'll just recap. That's not good. Decrease 8.7. Saw reaction and fallen orders after receiving orders for multiple large projects in the previous fiscal year for the development of power transmission line networks in Japan. Works for inter-regional connection lines as well as construction and repair for large-scale projects. So let's take a look at what they're forecasting. Okay. Further economic growth is expected with a positive cycle of income to expenditure and the improvement of corporate revenue taking place on the back of moderate recovery trend. The outlook is expected to remain unpredictable as uncertainties that affect economic activities are growing, including prolonged geopolitical risks, slowing down of overseas economies, and price hikes to supply chain. Okay, net sales are expected to increase 3.6 billion year over year. This is due to abundant construction contracts carried over from previous years, as well as steady sales expected construction. Okay. Both operating profit and ordinary profit are expected to increase slightly year on year, thanks to the effect of increase in net sales as well as price negotiation with customers and cost reduction efforts. Profit margins, however, are likely to remain tight. The impact of the soar of material prices. Increase in personal expenses and other factors. Yeah, so it doesn't look like. Yeah, it's not predictable. Okay, so it's the next one. We move on to next. Yeah. So, even though they have a 4% div yield, trading at 5 times EV/EBIT, including long-term investments, it's one of those companies where there's just not much room for growth, and it's more of a one-time thing, so it's a no-go. Ippon Densetsu. So what does this one look like? Okay, 165 market cap, 102 enterprise value, including long-term investments. So that one is 70% of enterprise value. Yeah, so this trades at 70% of enterprise value. Decent margins. Cash flow negative. We'll just have a look. Also, prices have gone up quite substantially. So 1,800 to went up 1,100 from 1,800. Wow. Okay, over 50%. Hello, we have two new viewers. Welcome. If you guys have not subscribed, please subscribe. What are some Japanese stocks you guys are looking at recently? I shall be taking a stock request if it's Japanese. So if you guys have any names you wanted me to look at, feel free to post it in the comment section. Yeah. So I'm going to change this. We are looking at 1950. Nippon Densetsu Kogyo. Done. Okay, what is this company's profitability? Okay, 7%, 5%, 3%, 4%. Okay. Formerly kind of low. Dropped very low and it resurrected a little bit. Okay, enterprise value Yeah, a lot of cash. And then in addition, they also have long-term investments. 7.2 times, 5.5 times. 9171 Martin Bradstreet. Okay, that is, thanks for being the first person to comment today. You know what, I'm gonna, like, it's boring if I look at companies people aren't interested in. So might as well, since we have one interested viewer, we will take a, slight detour and take a look at that. 9171. Okay, Martin, what do you like about 9171? Kuribayashi Steamship. Oh, wow, Steamship, okay. Okay, price is... Okay. So since April, it went up around 30%. Price has moved, been quite volatile this year. High of 1300. Started out the year around 900. Okay. Description. Okay, Kuribayashi Steamship engages in the marine transportation business in Japan and internationally. Okay, it transports cargo, including paper products, used raw material, cast and forged steel products, starred vehicles. Okay. Company also provides land and sea integrated transportation services, including loading and unloading of cargoes and collection and delivery of cargoes, coastal tugboats, barges that transport oil refinery. Okay. For refineries and blades for wind power generation equipment, wholesale of fruits and vegetables, tram services for bulk cargo transportation. Okay. Also involved in the ferry, hotel, and ship operation businesses. Furthermore, the company leases real estate properties such as stores. Okay. Interesting. So it seems like if there is like some import-export activity, this company would definitely benefit from that. Margins are pretty low. COVID would have affected the company for sure. So it's kind of, okay, gone back to its pre-COVID levels, slightly better than 2019. SG&A margin increased recently, so that's not very good. What is the last 12 months? What is last 12 months looking like? Let's see. Last 12 months has looking better. Looking better. And then, okay, as debt. Okay, let's see. So market cap wise, it's gone up 14.33, an extra, let's see, 5 billion here, so this is like 19 billion. Slightly less debt than before. Minority interest. Okay. Sorry, 19 plus 3.6, so yeah, so they're still around the same. Let's call it 22. Statement 22 on, okay, just under 10, roughly under 10, 9 to 10 times EV/EBIT. What's PE like? So 14 on 2.28. Okay, around 7. Okay, let's take a look. Keep in mind, I'm also new to this type of company. I don't really look at transportation companies very much. So let's see. But I can learn something. I don't know if I asked this question yet, but Martin, what do you like about this company? What do you see in this company that is quite interesting? What is their dividend, by the way? Let's take a look. Dividend is 2.2%. Yeah. So, let's see, operating business information, domestic liner, domestic tram ships, ocean going short sea tram ship, ferry, hotel, real estate, fruit and vegetable wholesale. Fruit and vegetable wholesaling. Interesting. Okay. What's their revenue growth? Let's look at that. They own many stockies, but I'm not sure now that it has repriced a bit. Oh, do you mean stockies as in it owns a lot of long-term investments? Say 52. So recently it's. Don't worry about that. Okay, so 44 to 52. Okay, so revenues are stable, but hasn't really grown. Something, right? Recently, 45, 47, 52. Yeah. Balance sheet. Okay. I see what you mean. So yeah, if they have 13 billion of cash and short-term investments. Wait. Long-term investments is 20. Wow. Wow. So okay, let me quickly open up another Koyfin tab here. So if we were to put in we would see something very interesting. Yes, enterprise value, including long-term investments, would be 1.6 billion. CAGR over the last 5 years, 32%. Quite nice. Very low margins though. Trades at 0.6 times. Okay, so if we include long-term investments, trades extraordinarily cheaply. What's the div yield? Div yield's 2%. So based off of the competitive landscape, are they able to buy other transportation companies with the cash that they have on hand? What does that look like? 14 billion. This company's like 100 million USD company basically in terms of valuation. So the idea is that this company is cheap, basically. So then the question is, how do we unlock that value? So then the question that we have to focus on right now is how do we unlock that value? So let's take a look at the company. All your information. They don't seem like they have an English site, so let's do that. Amend the securities report. Okay, we'll convert that in a bit. Do we have? I would like to see your investor presentation if you have one. Security report is okay too. What did they change? Let me just quickly take a look at what they changed and convert that in with ChatGPT real quick. Oops, that did not work at all. Let's do that. Copy text. Okay, so let's see what they say. There is an omission in attaching the articles of incorporation, a document required to be attached under Article 24, paragraph 6 of the financial instruments. Well, therefore, we are submitting a correction report of the correction report for the securities report in order to attach the omitted document. Okay, so they just forgot to attach a document, so that's fine. Not a big deal. Resource room, so maybe it's in there. Please translate to English. Business report. What is business report? Okay, so they have something that's a smaller version of that. I don't know if this will convert properly. Let me do that. Okay, so we will download these documents and then we get to convert them. Give me a second while I convert these documents. Okay, I have the business report. And then we need the SR right now. Securities report. Okay, but while we wait for that, let's figure out the business report. Wow, their 152nd fiscal year. Okay. So that just means that this company is going to be a very safe bet. It's going to continue probably to grow. I mean, it should be just transportation, import, exporting. Our main Hokkaido liner business saw an increase in volume of general merchandise and cargo vehicles transported, partly due to the 2024 logistics problem, also due to improved profits on short sea routes. As a result, net sales for the shipping business were 49 million yen. Operating profit is 2.3. Okay, so just under 5%. Still 4%ish. In the hotel business, sales increased due to inbound tourist attractions. Operating profit is 230. Okay. Additional operating profit of 282 in the real estate business, and losses in other business were added, resulting in 53 billion in sales. Operating profit 2.7. Okay, so just over 5%. That's good, because real estate is doing well. So if they're able to continue, because they have so much cash, they can definitely use that towards real estate into other segments. Yes, U.S. tariff policy would definitely impact this company. Okay, so tariff policy would definitely really impact this company. Japanese economy continues to experience high prices and weak consumer spending, but the employment environment improved due to a growing sense of labor shortages, and wages also rose. That is true. Wages have gone up across the board, as I've seen in a lot of companies. Overseas in the United States, capital investment has decreased due to cautious stance on lowering policy interest rates. Consumer confidence has also deteriorated, and signs of an economic slowdown are visible. In Europe, the economy is recovering as policy interest rates continue to be lowered and consumption has remained strong. In China, domestic demand is recovering thanks to policy support, but external demand remains sluggish, and the country's autonomous recovery is weak, resulting in economy recovery lacking sustainability. NYK's group's domestic liner business, shipping business, they experienced a gradual increase in modal shift from land transport to sea transport due to the 2024 problem. I don't know what that means. Further cargo movements of construction materials, which are suitable for large lot transport and general merchandise, driven by increased inbound tourism consumption, were strong. So cargo movements of construction materials and general merchandise were strong. Okay. And general merchandise is because of inbound tourism. Okay. So although fuel oil prices remain at high levels, a significant increase in cost was avoided thanks to the continued implementation of energy efficient operations and the effect of subsidies to mitigate sudden fluctuations in fuel oil prices. This, combined with the contribution of increased shipping volume, resulted in increased revenue and profits. Okay, on the coastal routes, China's full-scale economic recovery was delayed and the Chinese New Year holiday had an impact, but efficient vessel allocation with an emphasis on profitability resulted in increased revenue and profits. In the hotel business, we saw an increase in both revenue and profits due to a strong inbound customer base, attracting more customers than the previous fiscal year. Okay, what is nice about this company is that because their profit margins are so damn low, if they were to redirect cash into a real estate and generate a return of 5% or more, they are already beating their core business. So it doesn't take much for this company in particular to kind of re-rate. Yeah. The real estate business performed the same level as the previous year, but due to an increase in maintenance and management costs, revenue increased but profits decreased. Ooh, that's not good. As a result, net sales increased by 4 billion compared to previous fiscal year of 53 billion, and operating profit increased by almost 1.2 billion. Okay, so that's very good. Very, very good. Okay. Okay, sales. Okay, let's take a look at these. Shipping matters. Domestic regular shipping business is increased consumer spending in land transport. This translation is really crap. So let me use actually the actual document. Let me see here. This is interesting. Give me a sec. Okay. Where's my ChatGPT? Okay. Let me put in that document into ChatGPT and then have it spit out the. Okay, so shipping business, there's an increase in modal shift from sea to, that's the first time I've heard that word, modal shift. Okay, modal shift refers to the transition from one transportation method to another, often shifting from less sustainable modes, like private cars, to more environmentally friendly operations like public transit, cycling, or walking. It's a key concept in urban planning and transportation policy aimed at improving efficiency, reducing environmental impact, and enhancing quality of life. Okay, that's getting a little bit too far there. Core idea is modal shift is essentially a change in how people choose to travel, encouraging a move away from individual car use into active, okay, whatever. Okay, so modal shift, some land to sea transportation due to 2024 logistics challenges. Hey, Martin, I don't know if you're still on here. If you are, a question for you is domestic sea transportation more cost effective or better for the environment, or land transportation? So if basically saying, if you just take the same amount of cargo and use trucking to transport it, would it be better for the, like, would be trucking, like, let's say you have to go from one end of Japan to the other end. I guess distance matters, right? Distance does matter. Distance probably matters, but essentially, if you were to do a domestic sea transportation, like if you load cargo from like one end of Japan to the north, so the southest point to the northest point, or northest point to the southest point, or the northest point down to like midsection of Japan, which is like Tokyo area, right? What would be the cost benefit of that? Like in terms of which one is more efficient? Is sea transport more efficient or land? Not sure. Okay. Okay, so strong cargo load volumes in construction materials, general merchandise. Okay, despite high fuel oil prices, energy efficient operations, and subsidies mitigated cost increases. Increased cargo volume led to higher revenues and profits. Higher cargo volume. Okay, so another question for you, because this is new to me. Typically, for these type of ships, at what capacity would it be? Because they have such low margins, right? Like obviously you want to be filled up to the max, right? But like, what is the lowest point? What is the break-even point? Is that like 90%, 95%, or 100%? Like what? It can't be 100%, but what is the break-even point? Like, oh, we're gonna fill this cargo ship for 80%, and then we're just gonna head out. You know, like what? Do you know what those are like typically? And then of course any point beyond that, let's say 80% is the break-even point. Any point beyond that 80% would go straight to the bottom line, right? And you get really good margin because of that. Okay, coastal routes. Despite China's slow recovery and holiday impacts, profitability-focused ship allocation led to increased earnings. Interesting. What does that mean? Profitability-focused ship allocations? On the coastal routes, although a full recovery in the Chinese economy is taking time, we secured cargo such as wood pellets from Southeast Asia, and efficient vessel allocation led to increase. Efficient vessel allocation. Curious what that means. I can have a sense of what that means, not really sure. Hey, I'm not sure when a shipment becomes break even, but I think a bigger thing to solve would be what are they actually shipping. I think we send cars, paper products. Okay, so they said that the reason why that they experienced good cargo volumes was due to construction materials and general merchandise sales because of tourism. That's what they're saying. Okay, hotel, higher revenue and profits due to inbound tourism recovery, which makes sense for hotel business. Increased customer numbers and unit prices. So yes, occupancy rates probably increase. The number of foreign tourists is increasing. Number of tourists is trending favorably. Cost and labor costs due to rising prices. Increasing costs. Sales went up, and now they're actually profitable. So sales went up 300 million yen, and then segment profits increased quite a bit. That's only 5%. But hopefully they continue to invest in this segment with their cash. Real estate. Real estate sales of, let's see, 666, but segment profit and loss is 282. How's it that high? Is this like lease management? Nobody Betsu Grand Hotel, a group company. Okay, shareholders get 50% discount. Oh, to go to their hotel. That's smart way of driving up business. Okay. Okay. Okay, so they 53 million next year. They're okay. 53. Slight decrease in operating profit. Well, actually, still around the 4% range. Ordinary profit increases a little bit more. Net income 1.9. This year it's 2. Still 7 times PE. Still 7 times PE. And then 2.4 on enterprise value. Let's just ignore the. I mean, we can do this real quick. Yeah, Hotel's definitely crushing it. So yeah, let me fill this out. Let me fill this out real quick. This is 9171. Oh, we should change it. We're not looking at, yeah, this is a wrong ticker. Let me just change it real quick. 9171. Kuribayashi Steamship. Okay. Kuribayashi Shipping. Sure, 9171. Last quarter is fiscal year 24. May 9th, 2025. Ignore that 2020, that's not right. Share price is 1149. Shares outstanding 12.739, 696.269451. Yep. What's in cash? Yay, more cash. Wow, okay. Deposits, notes, receivable, securities. They have some short-term securities. 115. Oops, wait, 155.412. Goods and products, raw materials, supplies. Why do they have raw materials and supplies? Oh, they do fruit, right? Right. I think it said that they do fruit or something. Was it this company? Wait, hold on a sec. Actually, I can just look at the revenue segments and I can double check there. Okay, wow, a lot of shit. Shipping business, domestic transportation, domestic ferries, domestic charter, international transportation, port code, warehouse, and then hotel. Oh, hotel in merchandise sales. Interesting. Okay, okay. Okay, so probably they have, like, let's say for the restaurant, for example, the hotel restaurant, that's probably something. I don't know what others is a business not included in report. Yeah, fruit and vegetable wholesale business. So they have a fruit and vegetable wholesale business. And then they have other income from real estate business. Other revenues are real estate rental income based on accounting standards. Okay, so this is just real estate that they've invested in, I guess, and then they generate some rental income. Yeah. So it's not really core operations, but it's more of an investment income, so it's in other income. Okay, interesting. Interesting. Okay. Okay, I feel like the play here, the angle here is like they need to be very aggressive with their cash balance or whatever, so that they can yeah, if they can turn into a Berkshire, that'd be nice. So they can just like a crappy version of one, but then at least they're reinvesting into like hotel, real estate, whatever, something with a growth that is more than their 4% margins. Then that would be good. Let's see, tangible fixed assets. Okay, now here's another risk for Martin to ask you is, are they beating their capex? Which means like, are their earnings from their ships actually able to cover the reinvestment needed in order to, when they need to like buy a new ship, for example? I don't know what the price of these ships are. I don't know what the cycle of these ships are, and then like, yeah, like, of course there's inflation, right? And let's say steel prices went up, right? So then the cost of a ship would also go up. So like, how many years do these ships last? And then if they need replacing, what does that upcoming capex look like? So it looks like they need $36 billion in in ships, and their market cap is 14, right? So accumulated depreciation 19, so they have 17 billion in ships, buildings, structures, tangible fixed assets. And no, I can look at that. I can look at that. Just if you knew the answer already. 35. Tangible fixed assets. 18. Wow. That's a lot of long-term investment. Holy crap. Long-term loans, deferred tax assets. I'll just ignore long-term loans here. That's okay. Liabilities. Okay. Short-term. Let's go. 1480. 2586.077. I think the ships do actually make money, but it's kind of tricky to figure out how much. Okay. Yeah, you probably have to look at free cash flow, removing the effects of real estate hotels and stuff like that, and their fruits and veggies. I guess fruits and veggies would be there's a little bit of synergies there because you get to control your transportation costs. So the margin from the transportation costs of these fruit and veggies are probably quite extreme. So like because you own you own the actual fruits and veggies business, it also adds on to the capacity, right? So like if you operate at, let's say, 80% capacity on your shipping or whatever, now you can increase it by like 1 or 2% because you have a fruits and veggies business. And yeah, okay. Let's see here. Other long-term liabilities due in 1 year. Okay, that's interesting. 2.5. Okay, I've never seen that before. But anything else? Corporate bonds due. Okay, more. Lease obligations. That's something else. Corporate taxes. Double check. Okay, short-term borrowings. Corporate portion long-term debt. Other long-term liabilities. Okay, cool. There's that. Corporate bonds, nothing. Oh, okay. That is long-term borrowing. Boom. Long-term accounts payable, lease obligation, deferred tax liabilities. Okay, that's about it. I'll just note the lease liabilities here. Okay, so net debt. It's still positive. So enterprise value, if we exclude long-term investments, is positive 17 billion. But if we include long-term investments, it's negative 2 billion. So it's definitely, yeah, definitely really nice. Let's see, net assets. Ooh, price to book extorted. Ooh, no, that's not right. My bad. 0.42. So low price to book. Non-controlling interest. Okay, there we go. 11%. Okay. One thing I would do is if they're trading that cheaply, why don't you just buy at the non-controlling interest? 25. 2.2. Tangible assets. Five, 3, 2. And thanks for bringing this up. This company does look interesting because of how cheaply it trades. Oops, wrong one. 314149131 first. Yeah, okay, so the lack of profitability of their business is actually kind of a blessing in disguise in terms of valuation, because it doesn't take much to generate a return above 4%, let's say, if you do it properly. So definitely with their cash on hand, they can definitely, hopefully they can allocate it more aggressively into other fields, such as real estate. And if they do that, then essentially, like, well, everything that they invest in pretty much can beat their current return. So they continue to, do well in this business. And because this is their 152nd year in business, it kind of points to the, I want to say, defensibility of the transportation industry that they have. They probably have some type of moat, but it's one where it's kind of like, it's difficult, to get higher margins than this. Yeah. And doesn't help that Japan's also like declining population, but hopefully with tourism, like if the trend is tourism is going to be maintained at a high level, and then general merchandise transportation is going to be at an all-time high, will continue to be high. Construction material wise, that I don't know. So they mentioned construction material, so we have to figure out our current levels of construction going to maintain. So the good thing about actually going through the entire section of construction companies is, one thing we've noticed is sales have gone up, large projects have gone up, governments are spending more money on projects, but I don't know for how long, and what the future policy is for this type of thing. So if construction from the public and private sector are going to continue to be robust, let's say, then this company would be able to maintain its 4 to 5% EBIT margins. Is probably what's going to happen. Yeah. Amortization of negative goodwill? What the fuck is that? Hold on, let me take a look at what that even, I don't even know what that means. What the hell does that mean? Probably, let me double check that translation. Let's see, 1604, and this wording, what is this? I have never seen that before. Really? This arises when a company acquires another company for less than the fair value of its net assets. The portion of that negative goodwill that is recognized as profit, typically immediately under current accounting standards in Japan and IFRS, rather than amortized over time. So the full term refers to the amount of profit recognized from negative goodwill during the accounting period. Okay. Huh, okay, that's interesting. I guess that could happen. I guess that could happen. Yeah, okay. expenditure for time deposits. Okay, that's it. So 1 year they had a lot of capex, 1 year they didn't have a lot of capex. Let's take a look at historically what the capex is looking like. Okay, so depreciation, let's take a look. It's 2.8. So recently went down. Down and then up, okay. Capex. Okay, some fluctuation, 4, 4, 2, 5, 10. Yeah, do some math. Okay, let's say 8, 9, 12, 11, 12, let's say 12, 16, 26, 31, 33, 37, 41. 41 over 10 years, so 4.1 average capex. So this capex being that low is probably not really representative. Probably just a period that they're taking a break. It depends if they're expanding their business, right? If they're, I guess if they have hotels and stuff like that, they do need to spend more capex. Makes sense. So then the difference is, okay, what is maintenance capex for their steamships? That's something we have to figure out. What is maintenance capex? I'll just call it transportation business. Yeah, and then which part is growth capex for hotels, real estate, fruits. Let's call it food. Call it 150. No, I don't really want to look into it too much. $1.2. Okay, we can do 120. Let's assume 10 years. Sure. Okay, so let's say 53. 6,000. What's it? 2,400, and then 3,000. 1,900. 1,900. This is probably 35. They would raise dividends though. That part is kind of crappy. What's their buyback program? See, is there, what is going on here? Hello? Crap, it just froze. Why my computer freeze? What the hell? Jesus Christ. Everything's frozen, guys. Give me a sec. Okay, it's back. Okay, Martin says something. Martin, I think you want to track down management plan on their site, fiscal year ending, blah, 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 announcement, immediate term. Yes, I do. I do look at that. I need to look at that and also look at, if they're doing buybacks. So first thing is buybacks. Backs. Div policy. Very important. We do have purchase, buybacks, acquisition of actually cash flow statement would show me that actually. Appreciation. Financing. Okay. Expenditures for, yes, they do acquire 209. That's not a lot. They do buy back shares, but not a lot. Right? Spend more on other things, it seems. 209. When a company is over 14 billion, it's like less than 1%, and then here is this one is just bad. Take a look at cash flow over here. Purchase of common stock, 68. That doesn't look very accurate. So this is, let's see, 24, 23. So we can look 2 years down here. Financial statements, look over here. And then okay, this is what does buyback look like in Japanese? Let's take a look. Might be this. Let me just double check. What is the translation here? Dude, I'm a genius. Yes, this is actually repurchase of shares. Okay, so not much. So none. So okay, this company's not buying back shares, which is crap. So bad management policy. That's the answer to that question. Bad corporate governance. So far, what's their dividend? Is there a dividend here? Dividend amount payment. So they're paying dividend. 151 on 14 million, 1%. Low, very low. Very low. They need to increase this. Okay, so let's see. You want me to look down the track down management plan on the website? The announcement of. Okay, I'll take a look at that. Is it a midterm report? No. Business report. You seen that? Equipment. No. Corporate governance? Performance report? No. You said February 20th announcement. Okay, see it now. Okay. Yeah, no, my chat doesn't allow me to click a link, sadly. Is it this document? This 42-page document? Did I get it right? Alright, cool. Well, I'll take a look right now. Give me a sec to download and translate it. So 9171 medium term. Download a medium plan. Did you find anything of note in the medium-term plan that was interesting? Okay. Awesome. Ah, okay. Well, that sucks. That is quite the translation. Okay. I can only... fuck. Okay, I'm gonna throw into ChatGPT, tell it to summarize the first 2 pages. I'm gonna do that real quick. Because that's not it. Clearly not it. Okay. Translate and summarize key points first 2 pages. Doc. Assume you are an investment analyst and a investment firm. What the fuck? Upload is pending. Fuck. Try uploading it again. Shouldn't be that long to upload. Still upload. It uploads 90% very fast, and the last 10% is just taking it. Okay. Just skip forward. Only the first couple pages are messed up. Okay. Sure. While I wait for it to, you know, do its thing, I'll just look into this. Growth strategy, sustainability. Okay, we want growth strategy. That's cool. Qualitative goals. Growth strategy. Growth strategy is leading the intermodal transport business. Focus on domestic shipping, aiming to become a company. I guess aiming to become the best company, or one of the best companies probably. Creating stable profits through development of both new and existing business. Creating stable profit. Okay, strengthening the promotion of DX. Sure, every company says that. Expanding our business through M&A. Cool. Ensuring competitive by strengthening technical capabilities. Yes, initiatives to reduce environmental impacts and contribute to 14 billion. This company definitely could get acquired though. Yeah, I think this would be a good target to get acquired by some sustainability management. Human resource, safety, that's bullshit. Governance, probably something. Key performance indicators, sales, profit margins, ROE, investment plan, cash allocation, PPO. Okay. Oh, you want me to skip right to page 36? Okay. Okay. Well, look, page 36. Which one is 36? Numerical targets. Not growth strategy? You don't want to look at that yet? Okay. Okay, growth targets. Sure. In response to the planned increase in domestic liner service from the first year of medium-term management plan, 2026, operating costs will rise, causing a temporary decrease in recurring profit. Sure. However, 27 onwards, the company plans to enjoy increased revenues from increased service, resulting in an increase in profits. Real estate business sales is stagnant, so they're going to invest in more in real estate sales. Hotel business going to increase. Sure. So I'm investing more in real estate. Operating profit of 3 billion. So if they get 3 billion. Okay, good. Some stable growth here. 35 or 36, they go into segment revenue, then move on to capital returns. Okay. 35. Okay. 3.5 billion. So the breakdown of how it's going to compel. So business, okay, so shipping business increases. Real estate doesn't increase. Hotel business increases. Okay, others. Huh, interesting. I would like them to be more aggressive on the real estate and hotel front. That means they're not going to be investing their excess cash flow into like investment securities into these things. What? Cost of capital 78%. It already has been below this cost of equity capital. Yeah, exactly, of course, bro. Like fuck, you're generating 4 or 5%, and your cost of capital 78%. Aim to achieve. Well, dude, if you're not investing into these other segments, how the hell are you gonna do that? Lending and utilization of funds within the group, strengthening capital cooperation within the group, implement flexible shareholder returns, reducing cross shareholdings, and acquiring. Okay, please do that. But how much are we gonna do that? I reinforcement, expanding, improving opportunities and methods for communication. Enhanced disclosure of financial statements. Cool. Investments to maintain and strengthen business foundation, 16 billion yen. Okay. Growth investment, M&A. Human capital, DX. 15 over here. Shareholder return, 15. I need to double check the actual wording here. Okay, that is actually 16 billion. Because that's important, right? Because sometimes they translate incorrectly. So this is actually 16 billion. Yeah, it's not inaccurate. Operating cash flow, they generate around 14. Financial cash flow, utilization of interest-bearing debt. Okay. Utilizing cash on hand, 7. I mean, yeah. Investments to maintain and strengthen the business. You have to spend 16 to maintain the business, bro. Give me 1 sec. Let me just take a look at the balance sheet. How's total assets grown over the years? Okay. Okay. Retained earnings. Is it growing? Okay, it's growing. Retained earnings by 10 billion. Retained earnings increased 10 billion over 10 years, or 9. Around 9. Assets go up. And they're saying they're going to put 15 billion in DX buybacks and dividends. I'd rather they spend more of that on M&A, but yeah, but for this part to be lower, that means they're gonna do, like, if we actually take this graphing as like this color coding, you know, this percentage weight as an actual indicator, then this is like 2/3. This is like a little over a third. It's like 40% of this. 7.5. So around 6 billion over 3 years. So 2 billion return. 2 billion returned. 2 billion returned. But are you gonna do that through dividends or? Let's see, how's that even possible? 2 billion return. What's their cash? Let's take a cash flow here. 6. This right here. They've been paying really low amounts, 1% ish. Buyback of shares barely in existence. Give me a sec. So this is nothing. And over here, most recent quarter, they paid how much? 170, 200, 370. So they're gonna bring it up to 6. So they do 2 bill a year. They do 2 bill a year. What's their? Give me 1 sec. So they do 2 bill a year. 160. 160 over that. 14. That sounds good. That sounds really good. Yeah, they better announce something then, you know. Then in that regard, a 14%, you know, yield, and they use like their cash and their long-term investment. Yeah. Another question is, how much cash do they actually need to working capital do they need for every day-to-day operations? So 2 billion a year So roughly 6 billion over 3 years for div buybacks is 2 billion per year or 14% yield. Yeah. Yeah, looks good. Maintain and strengthen. Operating cash flow 14. So they're gonna get 14 of cash flow, but to dish out 16 to maintain and invest. But they have been profitable. They have been generating a positive income over time. So the shipping business is should be a profitable business, even despite the large amount of cash flow that it has to dish out. Let's see. Actually, I would actually have to model that out a little bit. Like I'd actually have to model that. It might not be actually clear. Yeah. Because they have spent quite a bit. They spent, I remember I said 41 billion, right? They spent 41 billion. They spent 41 billion. Well, actually, when does this extend out to? I thought this extended out until 2027. So I'm not actually sure. Is it saying that is returning this over the medium term, so over the next 3 years? Because if it is the next 3 years, then it's 6 billion, right? And then it's right. So to give back 6 billion in 3 years, you have to spend 2 billion a year on average, right? So, and if that's the case, 2 billion on a 14 MCAP company, and that's right. So what was 15? What's the 15? I want to see. Yeah, so brief overview. Brief overview is I can already say that this is definitely a is this A plus or A? Yeah, if they actually follow through with 2 billion a year, this would be an A. This would be an A for sure. So thank you for that. I will do that. And what is required? A couple of things. What is required? So let me just do an overview. 9171. This is Kuribayashi Steamship. Give it an A. Okay, so what do we like about this? So we like expected 2 billion a year of capital return to shareholders through div, just buyback. Double check translation. Yeah, probably by reading security report. And then you can even email. You can even email IR if you want to too. That works too. 14 billion MCAP. Long-term investments of 18 billion. EV of -2 billion. Areas for growth and sustained. Areas for continued rev growth and slight improvement cost structure leads to increase in operating income over 2027. Company should aggressively invest excess cash, yes, LP investments into real estate, hotels, anything generating a higher return than it does right now, which is a very low bar of 4 to 5%, even 3.5, and honestly. Right, 0.4 times price of book could be target for acquisition. Yeah, another thing to look at is who are the bigger competitors, because if they try to 0.4 times price of book, then instead of buying a fleet, like instead of investing in transportation infrastructure, you literally just buy the company right now, and then you have your own transportation thing, right? So it's like it's better to buy out this company than it is to even invest, and they're growing, and they have a load of cash. So this is like a no-brainer in terms of, but I think this is a, how would I invest in this? This is kind of like this is one of those systematic bets you put in the portfolio. Don't expect it to do much or go anywhere. You just like buy and hold, and then but you need a basket of these because you just need 1 in 20 for it to work out type of deal. So this is more of a, you need a basket investment approach. This cannot be a concentrated position. Unless you see something that leads to more growth or whatever. There's some short-term catalyst for it, or else, yeah. What does that say? Yours? Oh, what? I don't know what you wrote there. I'm on the same page. Are you on the same page as in the commentary that I just gave? Oh. Yeah. So yeah, I like this. I like this company. Thank you, Martin. Thanks for that. Very nice. Okay, seems like sometimes they just return capital and instantly re-rates, but kind of hard to understand the shipping business no matter how hard you try. I think one concern for me that I want to also note is to figure out concretely whether shipping business truly makes money. Yeah. So look into CapEx, depreciation, maintenance, CapEx, etc. Something like But yeah, no, not bad. Super cheap. Wish they just increase the dividend right away to 5%, and then this company would re-rate just off of that, and then say, oh, we're gonna buy back fucking 1 billion even in this semi-annual period. Then that's already really good. So you don't need much. And then what is the pricing? What is the pricing of this stock right now? Yeah, that's 1149. I think it does. I think that does, and the indicator are two things. One is the assets keep going up, and the second portion is retained earnings is going up. So if they're not doing that, then either assets takes a hit or retained earnings takes a hit, right? So, but both have been going up, so should be fine. But I would like to figure out exactly what the business is actually making, right? Because they spent 41 billion in 10 years on capex, right? And yeah, what is the actual return from doing such a thing, right? So yeah, that's difficult. Yeah. So definitely should be profitable. It's just like, what is the level of the profitability here? That's what I want to figure out. So let's see here. That's 2021 300. It has 4x. Double, so it's 2018. Bam. 240, high of 700. Lost 2/3 of its value. Interesting. Nice. No worries. Thanks for giving that. I was able to add another A tier stock onto my list, which is nice. Always nice. Okay, so how many do we have right now? 8. Oh, this should be. Oh, this is on the wrong side of the things. This should be in the August 5th one, but that's okay. Yeah, and then we're timestamp that because let's see, we're at 1 hour 40 minutes. So I probably talked about this at 1 hour 35. Yeah, so I should recap. Okay, so essentially 9171 is Kuribayashi Steamship, so they're a transportation company, having really low margins, but they have their net cash. Well, they have net debt actually. But their long-term investments, or investment portfolio exceeds the entire value of their market cap. So they're trading at around negative 2 billion enterprise value. The company says that they're going to unlock some value by investing 6 billion over 3 years, so 6 billion per year. But historically, they haven't done anything even close to that. So historically, capital returns have been very low. Dividend yield has been like 2%, and then barely any share buybacks. Only some share buybacks over the last 2 years, but they increased it recently in the most recent year to around, I think it was like 200 million or so. So that's going to be, if they do follow through, this plan is going to allow the stock to re-rate, hopefully. Yeah, so growth in this company comes from a few areas. One is that they're going to continue to grow their core business by investing either through M&A or through maintaining their current business, looking at their cost structure and being more efficient, whatever that means, if that's actually true. I hope they continue to aggressively use their long-term investments and invest in hotels and real estate because those are actually generating positive returns for them. They also have a fruits business that's also, I don't know if that one's doing well or not, but might do well. So I hope they take their actual excess cash and actually use it for M&A, to do acquisitions, and to expand in areas that are kind of like fail-proof. So real estate and hotels should do well, and hotels should do well in Japan. And they trade at 0.4 times price to book, so they could be an acquisition target. So anyone, instead of, they have so much assets on their balance sheet. So they have what was it? they have 57 billion assets on their balance sheet, and with an MCAP of 14, so and enterprise value of that negative. So any company that wants to actually expand into this industry, or if they're an existing transportation company, then what they should be doing is make a bid for this company instead of building out that infrastructure, because you get literally a 60% discount if you were to build everything from scratch on your own. I guess the thing that you have to look at then, the follow-up question to that is, what are the cross-shareholdings of this company? How much of this company is owned by another company? Whether they can be bought out. Is it family-owned? Yada, yada, yada. That type of thing. So, but that's for you guys to figure out. What else? Did I miss anything else here in these notes? Yeah, figure out if the shipping business should be making money. It should be making money because assets has been going up and retained earnings have been going up. So that's two indicators that it is making some money. It's not destroying shareholder capital through capex, because let's say the price of a ship goes up. So basically, they are beating the inflation of the ship costs to reinvest in the business. That's what it seems like right now on first glance. Yeah, so that's 9171, and because of those factors, it's an A tier stock. Cool. Okay, continuing on. 144. What company was I looking at before? I think I skipped this one, right? Okay, watch them. Raytech, Nippon, Densetsu. Let's see here. Okay, which one of these five looks the most interesting? So I'm gonna go from that perspective. Okay, so. Oh, okay, this one looks interesting. Kuribayashi. Okay, well that is already we already factored that in, but that was very interesting for sure. Yeah. So one of these are 30% discount. So enterprise value, including long-term investments, is 70% of enterprise value of that company. So technically, this one is actually cheaper. 1950 is cheaper because it has net cash on the balance sheet, whereas this company does not. Which one has higher margins? Okay, one has slightly higher operating margins, but there's some non-operating cash flows, profitability there. This one trades a little bit cheaper, 4.7 times. Next 12 months looking pretty dim, so I don't like that at all. Oh, but this one has negative free cash flow. Could be that they're investing into their business, so hard to tell. Okay, so out of this list, I'm looking at 1950, and if that doesn't work, then we basically scrap this entire list, and then we move forward. So 1950. Okay, price has also ripped 1800, ripped 1000, so up 50%. Oops. Description. Engages in contracting electrical equipment construction work in Japan. Did I look at this already? I think I already looked at this. Wait, that's Raytech. So maybe, hold on. Okay, well, we'll just take a look at the IP. Railway electrical work, general electrical work, information, communications, construction, environment, and energy construction. So a lot of them do something like this. Do we have an English portion? Oh, they have English. Nice. Very nice. Wait, but there's an English side. Why is this not? Oh, I see. The English side has nothing. So that's what's happening. The English side has absolutely nothing. Okay. That's what it looks like. Yeah. Let me double check. So let me double check. Company. Yeah, I don't think so. I don't think so. Okay. We're gonna have to convert this real quick. .1950 IP. Okay, 7% margin, slightly higher. Oh, a lot of cash. A boatload of cash, yeah. The cash balance has gone down, though. Gone up and then gone down. What's our price to book? 0.7. But might not have factored in their price of 0.7. Last 12 months. Let's see. 0.6, 165. 165. So we have to take a look at financial statements. $209, 165, around 7.8 times price of book. Yeah, 0.75 times. Why is it doing that? So we're just trying to see how they're going to grow. If there's some growth component here, then this could be good. Oh, very concentrated on JR East. Their contracts are very concentrated on JR East in terms of railway. Like 40%, so I don't like that. I don't like customer concentration. Unless this is very predictable. I don't know what historically is, because I'm new to this industry. I don't know if it's historically like that. Increase from 64 to 90. That's still 3% though. Yeah, still pretty low. Orders have remained high. Balance carried forward at the beginning of the period. Wow, so a lot. Oh, this is the forecast and this is the result. Oh, they got more sales. Cool. more sales with a lower SG&A, so that's good. Okay. Operating income factors are due to increased construction, fixed costs, so some type of operating leverage there, system costs, labor costs, other costs. Okay. How are they going to grow? Tell me how you're going to grow. Oh, major railway projects. Okay. Public and private. JR measures. This is rather complicated. Major orders received. Yeah, I don't know what the sustainability of it is, because if 40% of your, a large portion of your sales are coming from one customer, I don't know, like, how consistently have they performed in terms of income statement? Let's see. Major fluctuations are pretty consistent. So they're at 201 right now. Okay, interesting. So pretty resilient, honestly. 14, 10, so 16 times PE. Okay, forecasts. So balance carried forward, increase orders, increase sales, increase operating profit. Okay. Same thing. Interesting. Increases our maintenance across the board. How are they gonna continue? Okay, medium-term plan. Okay, so what do they want to do here? This is growth investment, strengthening the revenue base, shareholder returns. Let's see, what is that? Corporate value improvement, energy-related business, general electricity, railway electricity, information communication. Our vision for 2031, with pride and responsibility as a leading company in railway electrical construction, we are expanding our business in the fields of general electric, information communication, environmental energy. Secure orders from JR East and other JR companies, increase orders from regular customers such as station buildings and schools, secure orders in the mobile field, expanding participation in public and private railway nationwide, participating in large-scale development projects nationwide, entering new businesses, metal recycling, community-related businesses. Not seeing much growth here. I would put this in the too hard pile, honestly. It's kind of difficult to really figure out, or at least it's not worth figuring out given it's not like that underpriced. So I think there's too many moving parts. A little bit difficult. Yeah, a little bit difficult to figure out. What are their buybacks? Share buybacks. Share buybacks. Oh. They acquired 5.2 billion of shares. Oh. And they're going to buy more. Okay, so implement share buybacks to improve capital efficiency and shareholder returns. They're at 0.75 times book, right? Maximum number of shares required is 600,000, 1.4 billion. 1.4 billion on what? Too little. Acquisition record in March, 300,000 for approximately 600 million. Reduction of cross shareholdings. 70% reduction by 2030. Strategic shareholdings from 32 to 10. Okay. Yeah. Not aggressive enough for the share buybacks, but target dividend payout ratio of 40%. 40%. What is their net income target? Let's see. I think I saw something like that earlier. So let's see. Next period. So they're at 216, 17, 20. So okay, if they generate 228 per share, 40% of that would be around 88. 92. Let's call it 90. 90 on still 3%. Still 3%. Not aggressive enough, I think. Yeah, put this in too hard pile. It's not bad, but it's not great either. So yeah. Okay, everyone. We've been live streaming for 2 hours nonstop, so I think that will be today's live stream. We were able to find one company, 9171, thanks to Martin. Thank you. Thanks a lot, Martin. And you guys have to go into around 135. Also, I think I did a more detailed recap around 140. At around 140 mark. I will review it later and post it in the comment section and in the description section. You guys can review it on why I think 9171 looks interesting and probably warrants some more additional analysis. And yeah, so that will be today's live stream. Thanks for tuning in. And I'll catch you guys next one. I will be releasing, I'll be doing more consistent live streams. So probably Monday, Wednesdays, at least twice a week, if not twice or 3 times. So if I do them, it would be like Monday, Wednesday, Thursday, or Monday, Wednesday, Friday, something like that. And yeah, I will be, given I have, let's see, we have around, we have 8 now. So I might be able to create a post like top 5 stocks I've found in the month of July, August so far. And I'll probably release another post on that. So you guys can look forward to that. It'll be released on my Substack. So if you guys haven't subscribed or followed me on Substack, please follow me. I prefer you to subscribe because I can at least retain your email in the future. But yeah, you guys can look forward. If you guys haven't, go to my Substack. I also have a new stock pitch that's out. So look at that. It's already gone up 5% since the earnings release. So go check that out. And yeah, looking forward to see you guys in future streams. Thanks for tuning in. And one thing I've noticed is that people aren't that interested in this section of the Japanese Company Handbook because it's kind of like construction is not very interesting for people. So I will be, I'll do variations. I'll try to make it more engaging by getting more of you to give a special stock request. And what I found is that when there is a stock request, because the company in itself has an opportunity already, you guys tune in a lot more and more attentive. So I will figure out a way to balance that and how to continue with the Japanese Company Challenge while being able to keep engagement up and viewership up. So yeah, thanks for tuning in, guys. Everyone, I'll see you guys next Monday. Yeah, the next live stream will be on Monday, probably around 4 o'clock again. So stay tuned for that. And if you're a viewer right now and you haven't subscribed, please subscribe.